Hi, this is Patrick Donahoe. This video is going to be exclusive for this particular blog. But what I wanted to do is explain how to utilize insurance in conjunction with something else, not just having insurance or a maximum accumulated life insurance policy as an exclusive investment. What we teach clients is to use one of the most profound provisions with an insurance policy, which is the loan provision. As you accumulate money inside of your insurance policy, the insurance company will lend up to the entire balance of your cash surrender value. Okay, so what I want to do is analyze a real estate investment. There's a client I have that that came across a property in Mississippi. He's from Mississippi. So let's kind of talk about the details of this particular property. Pardon my my drawing skills. So he acquired the property for $40,000. Okay, so that was the purchase price, and then $10,000 was the rehab cost. Okay, after the property was finished, okay, again he has $50,000 as his initial investment. The property would have been worth $75,000. Okay, now he was going to try to sell it, but let's just assume that he rented it out. He said his rental income would probably be about $750 per month. So let's do a 5-year analysis on what the rate of return would be. Okay, all right. 5-year rate of return is going to be 75,000 times 60 months. So let's do that calculation. So 750 times 60 equals $45,000. All right, so $45,000 plus the $25,000 he had as far as built-in equity. So his total rate of return is going to be based on $70,000. What we would do is we would divide $50,000 by 70. So $70,000 divided by 50 equals 1.4, so 140%. All right, so pretty simple transaction. Now, obviously, we're doing a 5-year analysis. You would think that the market would come back. Who knows? So let's just use this to be simple. So, what are his real options as far as purchasing the property? He can use cash, okay, which most individuals will use. You can use a self-directed IRA, okay. We typically teach the banking system. So a self-directed IRA, you're going to have to pay taxes when you make withdrawals. So it's going to be subject to a 30%, 25%, whatever tax rates are when you start pulling out the money. So even though there's no taxes right now, there'll be taxes in the future. So here's how we use the banking system. Okay, let's assume that this individual has $50,000 in his cash value. The insurance company will lend him, and hopefully all of you understand the power of leverage, but they will lend him $50,000 against his cash value. So his cash value will continue to earn dividends. Okay, let's say the dividend is 6.5%. It will continue to earn dividends even though the insurance company has lent him money at 4.76%, which is one of the companies we use right now. So 4.76% is what he would have to pay. Here's what's awesome about loans that are basically lent by the insurance company or given by the insurance company, collateralized by your cash value, is there are no repayment terms. So you can pay it over 20 years, you can pay it over 30 years, you can pay it over 5 years. They don't even require you to make payments. They will add that interest charge to the balance of your cash value, and if you die, they will reduce your death benefit by the balance of your policy loans. Okay, they don't make you qualify for this loan. You can get it within the same. If you request it in the morning, you can get it the same day if you really need to. Typically, comes in a couple days. Okay, it doesn't show up on your credit. They don't pull your credit. They don't ask you to explain why you need it. You basically sign a piece of paper, and that's it. Okay, so it's very easy to acquire these loans, whether it's $50,000 or $500,000, just as easy. So let's do some calculations as far as what the difference in transactions would be. So remember, this $50,000 is going to be earning, even though you've taken out money here, okay, it's going to be earning 6.5% regardless. Now, any interest associated with a real estate transaction, business transaction, or investment transaction, you're going to be able to deduct the interest charge, okay, from your total profits. Okay, I'm not going to go into a lot of those calculations today though, but I want to calculate this now. So let's say that you set yourself up on a 20-year repayment term. Okay, so let's find out what that's going to be. So I'm going to flip my screen around here. So 50,000, 4.76 over 20 years. So you're going to have a $323 payment. Okay, some goes to principal, some goes to interest. Now, what we're going to do is, instead of pocketing the difference between the 750 and the 323.38, we're going to add that 750, the 750 a month in rental payments. We're going to add that to expedite the payoff of this policy loan. Now, why do that? With a traditional 20-year, 15-year, 30-year mortgage, it wouldn't make sense because you make an extra principal payment and none of that money is accessible. However, with the insurance company, you put a monthly payment into $500, you can take that money right back out. Okay, so you put in an additional $500, $10,000, $50,000, I mean whatever. They will give you 100 different loans not to exceed the total balance of your cash value. Okay, so let's make an extra principal payment of $750. So we'll clear here, $750 minus, what was it, $323.38. $323.38. Oops, minus $323.30. Ow, crud. 750 minus 323.38. Okay, so 426.62. It's early. All right, so 426.62. 426.62. All right, so what we see here is that at that 5-year mark, the balance of this loan is paid down to $12,711. Okay? Alright, so let's go back here and kind of calculate what's going on here. Alright, so over this 60-month period of time, you have $45,000. Now you're gonna have to minus out, okay, 12,000. What was it? 12,711. 12,711 to basically pay off the policy loan once the property sells. Okay, so $45,000 minus 12,711, so that's $32,289. Okay, now also we have to add in the $25,000 here because of the built-in equity. $25,000. Okay, so 25,000 plus that is going to be 57,289. 57,289. All right, so we see here that 57,289 is less than $70,000. So the rate of return is going to be less. Okay, but we have to calculate two things. First off, you have to calculate what the interest charge is going to be, which is a write-off against the accumulated value. And this is all things being equal. If it's self-directed IRA, it's a totally different transaction. But $12,711, your total interest charge is $7,712. Okay, so now you have a write-off of $7,712, okay, against your transaction. Now you could have it in an LLC. Okay, now this $7,712 is basically a deduction. Okay, however, you have to remember that the $50,000 inside of your cash value is still earning 6.5% every single year compounded. So if we do a very simple compound interest calculation on $50,000 over 5 years at 6.5%, you're going to earn 18,504. 18,504. All right, so 18,504 plus this. Okay, so what's our total? What's our total yield? All right, so let's go to the trusty calculator and go 57,289 plus 18,504. All right, so now you're at 75,793. Okay, so let's divide that by 50,000, which is the initial investment. So now you're at 152, 12% higher, and I did not include the 7712. Okay, so hope all of you understand the power of leverage. Okay, with the insurance policy, we're not using it exclusively for accumulation. Okay, we're using it because remember, this is also tax free. And I showed that the equivalent of that would have to be a 10% rate of return in the market with the lack of management fees, taxes, and then the death benefit. You have a permanent death benefit that is if you look at the similarities between maximum funded whole life insurance and real estate, they're almost identical. Now, you can use this in conjunction with any type of business. Every single time you're going to make out ahead utilizing the loan provision against your insurance policy than you would just using cash. Okay, and plus, yeah, you increase your deductions, increase your expenses, reduce your tax liability. So hopefully this has made sense. I would invite you to, and I'm going to put a link in the blog post, but I would invite you to listen to the interview that I did with the Real Estate Guys radio show, which kind of helps with the concepts and the theory behind this and how it relates to real estate. But I appreciate you guys listening to this today. Have a good one.